So there is some big news with Workhorse stock that I heard about a couple of days ago, and I wanted to let you all know about it because I do think it signals that Workhorse stock might be about ready to take off. But before I discuss what the news is, I wanted to point out something interesting about the chart for Workhorse stock. Now, normally I don't get that much into technical analysis when it comes to stocks, but in this case it looks like a pretty clear pattern we are seeing with Workhorse stock right now. And so I wanted to make you aware of it. So if we look at the chart for Workhorse stock, we can see that it looks like there is a support level forming at around $15 a share. As you can see, it has now bounced 3 different times from this $15 a share support level. Once on July 10th at $15.18 a share, then again on July 17th at $14.93 a share, and then a third time on the 24th when it hit a low of $15.15 per share. So again, we can see a pretty solid level of support right around the $15 per share mark. Now, I believe the main reason for this is that there are a lot of people who have bought Workhorse stock that are adding to their positions. And as the price drops to $15 a share, people are using that as an opportunity to buy more shares. So this, I do think, will be a critical level of support for Workhorse stock moving forward. And if Workhorse stock can stay above this level of support, then we could see it go on another big run sometime soon. But if negative news comes out and Workhorse stock falls beneath this $15 a share support level, we could see the stock price drop further. So like I said, I don't get too much into technical analysis on this channel, but this seemed pretty clear to me, so I wanted to mention it really quick. Now let's get into the big news with Workhorse stock. Just a couple of weeks ago on July 10th, ARK Invest added Workhorse stock to their ARK-Q ETF. The ARK-Q ETF is one of many actively managed ETFs that ARK has, but this one focuses specifically on autonomous technology and robotics. And if we go to the ARK-Q information page on ARK's website, we can see that this fund focuses on companies that develop, produce, or enable autonomous transportation, robotics and automation, 3D printing, energy storage, and space exploration. Knowing this, it is no surprise that Workhorse stock was recently added to this ETF, since Workhorse does specialize in energy storage as an electric vehicle manufacturer. But there is another big reason that I think ARK added Workhorse to their ARK-Q ETF. And we can see a clue as to why they added Workhorse if we look at the holdings of the ARK-Q ETF. If we look at the holdings, we can see that Tesla is the largest holding in the ARK-Q ETF, which is not too surprising if you have listened to any of Cathie Wood's interviews. Also, there are some well-known large cap stocks in this list, including Google, Apple, Amazon, and Nvidia, just to name a few. But there is one stock that stands out to me that gives me a clue as to why Workhorse stock may have been selected. If you look at the 18th largest holding, you can see it is a company called AeroVironment, ticker symbol AVAV. AeroVironment is a small company that makes unmanned aerial vehicles for both commercial and military uses. And the reason I bring this up is because Workhorse is also developing its own drone delivery service on top of manufacturing its electric vehicles. And I think this is a big reason ARK zeroed in on Workhorse stock and added it to their ARK-Q ETF. In fact, there are a number of different companies in this ETF that are trying to capitalize on autonomous drones. Amazon, for example, has been quietly working on its own autonomous delivery drone for many years now, which they call Prime Air. This drone can autonomously deliver a package under 5 pounds to homes within a 30-minute radius of their Prime Air fulfillment center. Also, Nvidia is working on artificial intelligence software for autonomous drones that will allow these drones to understand and react to obstacles they might encounter while flying. Nvidia's AI solution is not only useful for allowing autonomous flight, but also for visual recognition and data capture. So I think the fact that Workhorse has this autonomous delivery drone solution is a big reason that they did get added to ARK's ETF. And in case you were wondering what the economic impact of using autonomous drones would be, Workhorse estimates that using its drones could cut down their cost of last mile delivery from 34 cents per mile all the way down to 4 cents per mile, which is a huge improvement compared to the roughly $1 per mile it costs for a gasoline delivery truck. Now, you do need to keep in mind that the drone delivery is something that might take a while for Workhorse to fully develop, but there are some catalysts that might help to make it happen sooner. One of those things is the recent sickness that is happening around the world right now, which has significantly increased business interest in touchless, contact-free delivery. And drones would be a good solution to help reduce the spread of diseases like the one we are currently facing. The other thing is that many different companies are starting to use drones, and this will put pressure on the FAA to speed up the certification process for these drones. This led CFO Steve Schrader to say in his interview with Bazinga that he believes that drone delivery is more like 2 years away instead of 5 years away. Also, any company that wants to launch their own drone delivery service still has to get certified by the FAA. So Schrader is also confident that they won't get beat to market by any of their competitors. And even though Amazon is already doing drone deliveries to customers, they are only doing it in England right now, not the US. So Workhorse is looking to be one of the first to do drone delivery when the FAA does allow it. Now, Schrader also gave some insights in that interview with Bazinga about the USPS contract. And as we all know by now, Workhorse is one of 4 remaining participants bidding for that USPS contract. But as Schrader points out in that interview, they are the only all-electric vehicle still in contention, which is a big deal. Schrader goes on to say that an all-electric truck is probably the best option for the United States Postal Service because 70% of USPS trucks only travel about 17 to 18 miles per day. And they make as many as 700 stops in a single day as well. So based on that, you don't really need massive battery packs or superchargers since these vehicles don't drive very far and can simply recharge overnight. The other benefit of Workhorse's all-electric trucks is that it will get the equivalent of over 40 miles per gallon compared to only 9 miles per gallon for the current USPS mail trucks. And this will be a huge deciding factor for who gets some or all of the contract. That's because the USPS desperately needs to find a way to cut costs. In fact, for fiscal year 2019, the USPS ran a deficit of $8.8 billion. And if you don't know exactly what the word deficit means, it means they lost $8.8 billion last year. In total, the USPS has lost $77.8 billion since 2007. So clearly buying Workhorse's vehicles won't save them from all of their financial woes, but it could help them cut costs. And in this case, every little bit helps. And as far as when we can expect a decision on that USPS contract, Schrader estimates that it should happen sometime in the next 2 years. Another advantage Schrader talked about in the interview is that Workhorse doesn't currently have any true competitors in the electric delivery vehicle space, and also notes that Workhorse is 2 to 3 years ahead of their competitor Rivian. And if you have read up on Rivian before, then you are most likely aware that Amazon is a big investor in them, and that Amazon has already ordered 100,000 electric delivery vans from Rivian, which they say should be on track for first deliveries as early as next year. But this can always get pushed back, and Workhorse is already manufacturing and selling their C-Series trucks to customers like Ryder. So right now, I would say Workhorse is ahead with their only competition coming from Rivian right now. But Rivian is only making EV trucks for Amazon, so it's not really a threat to Workhorse right now either. Also, some more good news for Workhorse is that they sold 20 C1000 delivery trucks to a Cincinnati-based company called eTrucks. So that is a good sign for Workhorse stock as well as they begin to diversify their customer base. The next thing I want to talk about is Workhorses Financials. Now, I touched on this in one of my previous videos, but I did some digging and found some relevant information that makes the financials of Workhorse look more appealing. If we look here at Workhorse's Q1 numbers for 2020, we can see that they had very little sales for the quarter compared to Q1 of 2019. However, Workhorse simply attributed this to a decrease in the number of trucks sold. So this number should be coming back up soon with sales of their C-Series trucks ramping up. Now, the confusing part about this is despite the net sales falling, the cost of goods sold actually increased for Q1 of 2020, which confused me until I read that this increase was primarily due to an increase in tooling costs for the C-Series production. So that is a good sign because the tooling represents a fixed cost and shouldn't be a reoccurring expense as they manufacture more vehicles. Now, if we look at the net profit loss, we can see that despite losing over $6 million in Q1 of 2019, Workhorse was able to post a net profit of close to $5 million in Q1 of this year. This unfortunately was not not driven by product sales. As we saw, they didn't really have many product sales for Q1 of 2020, but rather this was driven by interest income from warrants and convertible notes tied to the company's stock price. And since the stock price rose dramatically in Q1 of 2020, this resulted in Workhorse posting a net profit for the quarter. So I wanted to break down the financials in detail because I thought it was important for you to understand why Workhorse posted a net profit for Q1 of 2020. And I also wanted you to understand that the profitability did not come from product sales. But despite all of that, there are analysts such as Craig Irwin from Roth Capital Partners that estimates that Workhorse could see EBITDA profitability as early as the end of next year. And EBITDA profitability is important because it excludes income from interest, which we just saw was the only reason Workhorse posted a profit for Q1 of 2020. So again, as production of the C-Series ramps up, it looks like analysts are forecasting gross profitability very soon for Workhorse, which would give the stock a big boost. So let's finish this video by talking about how to correctly size your position in Workhorse stock. As you can see, Workhorse stock only makes up 1.38% of ARK Q ETF's portfolio. And this is actually what I would recommend for most people watching, especially if you have a large portfolio you are investing with. Now, if you have a really small portfolio under $10,000, you could probably go all the way up to 10% of Workhorse stock in your portfolio, but this is still a very small company that is not yet profitable. So you do want to manage your risk by not investing any more money than you are willing to lose. But that being said, I think the long-term catalysts are strong here for Workhorse stock. So I do think it is worth holding on to for a while. I just want to encourage you to have good risk management in your portfolio. Also, there are a lot of great growth stocks out there, so keep that in mind when you are choosing stocks for your portfolio. If you guys want to see my previous videos on Workhorse stock, you can click one of those videos now. Also, make sure to hit the subscribe button if you are not already subscribed. I would greatly appreciate it. And with that, thanks so much for watching. I'll see you in the next one.